I recently participated in a wealth conference where a New York Life sales associate tantalized a primarily retail audience with the benefits of investing in private equity. The audience enthusiastically embraced the amplified American dream: a house on a hill, stocks, bonds, and private equity. Whether they understood or could afford it, much like the rabbit chasing a sugar-saturated treat, they had to have it. When regular folks and their life insurance sales professionals lust over an investment, it's hot. However, we may do well to pause to determine whether it warrants the rabbit's inordinate craving. Let's begin with a brief explanation of private equity, PE, which is quite like house flipping. PE investors purchase a property to improve and quickly sell for a gain, much like how real estate investor PE firms use other people's money to finance meaningful improvements and potentially profitable exits for gains. Please see this diagram. Private equity deals are complicated, typically requiring investment partnerships that buy and manage companies before selling them. Importantly, the complications associated with these investments tend to necessitate a measure of sophistication to properly understand the specific risks associated with these opportunities. They are usually only offered to institutional and accredited investors who have the sophistication to trade unregistered securities. Here is an outline of what constitutes an accredited investor. Clearly, these tricks aren't for everyone. So, why are they so popular? The tantalizing prospect of earning potentially exceptional returns. Like sugar, when it works, the returns can be sweet. Also, like sugar, when used in excess, the consequences may be adverse. If you are an eligible accredited investor, we can consult about potentially appropriate private placement opportunities. As this chart demonstrates, private equity has been competitive through 2021, as we glean from the article titled, Long-Term Private Equity Performance, 2000 to 2021. However, like every other investment asset class, private equity has struggled through the heart of the Fed's rate hiking process. From November 25, 2021 through January 3, 2024, publicly listed private equity fell 8.85%, which was worse than the S&P 500, which appreciated 3.25%, and the Nasdaq appreciated 3.23% over the same time frame. Please see this chart. Further, we see from the article titled Are Private Equity Valuations Too High? The decline in private equity valuations from their high at the end of 2021 to June 2022. Why the precipitous drop? As explained before, most private equity transactions, like house flips, rely on debt. Using other people's money for speculative investments can be expensive. We note from the article titled The Rising Cost of Debt, Impact on Private Equity, and this chart, that the cost of leverage in private equity has doubled over the past 18 months. This may be why private equity declined in 2022. This increase is linked to one of the Federal Open Market Committee's most aggressive tightening cycles, illustrated with this visual. The Fed raised interest rates from 0 by 25 basis points in March 2022, to the current rate of 5.25 to 5.5%. This has had an adverse impact on private equity deal flow. Please see this graph. Private equity was not immune to the adverse impact of the Fed's rate hikes. However, the prospect of a Fed's pivot is forcing stock market skeptics to become believers. This may also be good for private equity. In Bain's Global Private Equity Report 2023, Navigating a Shifting Tide, we see illustrated, private equity investments made coming out of a downturn typically generate superior returns over time, as seen in this chart. So perhaps now is an attractive time to consider in a historically compelling asset class. There are meaningful risks and restraints, so having a conversation with a qualified professional may be a useful initial step. If you are not sure if you are a qualified investor, it may be helpful to give me a call and discuss it. For those that are not qualified investors, there may be indirect alternatives offered through retail-focused publicly traded fund companies. Please consider this chart from Morningstar's article titled "How Has Private Equity Investing Fared for Mutual Funds?" Mutual fund ownership of private companies grew to as much as $23 billion at the end of 2021, before falling to $15 billion as of June 2022. There are several fund families that may offer retail investors competitive funds that may include exposure to private equity investments. We are exploring various opportunities that may earn a position in our discretionary models. Perhaps these indirect investments may potentially afford us beneficial exposure to private investments. However, it may be very challenging for anyone to make meaningful gains in their private equity investments until the IPO markets get going again. In a recent Goldman Sachs article titled "Reopening the IPO Market," Lizzie Reed, global head of the Goldman Sachs Equity Syndicate Desk, says,
"The market is open. Stay forward-footed and have a strategy."
Perhaps there is hope ahead. Please give me a call if you want to explore the practical implications for any of these ideas in your investments, or would like to understand more.